Let's get back to the broader market now with our panel. Joining us now, Meghan Shue of Wilmington Trust and Venu Krishna of Barclays Investment Bank. Good afternoon to you both. Meghan, I will start with you because you've been on for months now saying that you're cautious about the equity market. Has anything changed?
Yeah, Morgan, first of all, thanks for having me. We have definitely been expecting a choppier second half of the year than we had in the first half. I think what's been surprising, at least for me, is that the market weakness has been a result not of deteriorating growth, but reaccelerating growth. And we've seen the importance of interest rates playing into basically what equity investors are willing to pay for stocks today, with the equity risk premium the lowest since 2002. It's just been very unappealing, the decision between equities and cash. I think going forward, we're still cautious on equities overall, but the prospects for both bonds and stocks are starting to look a little bit more attractive. Certainly on the bond side of things, expectations for a higher probability of rates to fall than to move significantly higher from here could lead to some nice total return for bond investors over a 12-month investment horizon. And then even on the equity side, I've been encouraged by some of the air coming out of the balloon. But for U.S. large cap, if you look at the equal weighted index, we're trading in basically the 20th percentile of valuations going back to 2010. So while the overall market might look expensive, underneath the surface, there are opportunities. And even in a mild recession scenario, it's probably going to be short, shallow, and I think equity investors are probably going to do okay compared to historical recessions.
Yeah, and yet breadth has been relatively poor. There's been a lot of focus, Venu, on the fact that we're going to need to see that really widen out for a rally to take root here. I wonder how you see it, because you got stocks at 7-month lows. You got the 10-year Treasury, at its highest level in 16 years. Issues, concerns with rates, concerns with geopolitics, and then so far what I will call a mixed earnings picture, or at least not a much better than expected earnings picture with the way investors are reacting to it. What matters now, especially as we come into mega cap tech week with 4 out of 7 of the Magnificent Seven reporting?
So let me start with your question on the narrowness or the breadth of the market you talked about. So we expressed this view in the summer when that narrowness metric was in the 99.5 percentile. And we were of the view that as it keeps getting that narrow, that in itself becomes a catalyst for a correction led by the leaders of the market. But we were of the opinion that big tech was in good shape, that we would use that as an opportunity to actually buy into that correction. So we've seen that correction. The second important point, we made from our perspective is that it is not going to broaden. And if you look at the ratio of SPW to SPX, it's collapsed and it's been flat over there for quite some time. And the reason is quite simple. If you look at where the earnings are coming from, they're overwhelmingly coming from tech, and within tech with a smaller subsegment of large cap tech. In fact, if you look at, for example, next year, if you strip out big tech, then earnings for the rest of tech and for S&P broader are actually down. And so S&P, even outside of tech, is trading at full multiples. Earnings are going nowhere. And there's really no catalyst for that to change. And hence, we continue to expect that broadening is more of a hope till such time that we see a tangible increase in earnings estimate, which in our view are very optimistic. So if you look at the consensus, it's about over 12% for next year.